This video is for educational purposes only. It is not personalized financial advisor before making financial decisions.
Meet David. He's 28, a project manager earning $58,000 a year, and his income vanishes the second it lands. He lives rent-free in an investment property owned by a friend, yet by the end of every single month, his bank account balance flatlines exactly at zero. He carries no emergency fund and no term life insurance. A single car repair or medical bill guarantees an immediate return to high-interest credit card debt. David isn't a single person. His numbers are a precise composite representing the standard cash flow reality for millions of early career professionals. The standard advice for this problem is to increase top-line revenue, but that ignores the mechanics of cash flow architecture. Earning a higher gross income will not fix an account that systematically routes itself back to zero. We are going to reverse engineer this exact paycheck-to-paycheck loop and rebuild it using a 5-rule system without changing his starting salary. Achieving early career financial stability is strictly a routing problem. Build the correct system and the willpower takes care of itself. This flowchart tracks David's $58,000 annual salary, starting with a gross monthly input of $4,833. Federal and state taxes, along with health insurance premiums, are immediately siphoned off the top. David contributes $200 to capture a 100% employer 401k match, injecting an additional $145 into his retirement vehicle. After these rigid, non-negotiable deductions, the actual working capital delivered to David's checking account drops to exactly $3,500. That $3,500 is immediately subjected to rigid outflows, the known, inflexible costs required to maintain his current baseline existence. Even living rent-free requires capital. Property tax, HOA fees, and baseline structural upkeep extract $380 a month. A car payment, insurance, and gas siphon off another $700. Sustenance and connectivity follow suit, pulling $600 for groceries and $260 for utilities and telecommunications. Finally, debt servicing demands its share, $280 for student loans and $350 for a consolidated personal loan holding 12% credit card debt. The mathematical subtotal of these non-negotiable expenses is $2,570. Subtract that from the net income, and David holds a theoretical liquidity pool of $930. If the math guarantees a $930 cash buffer, why does the account consistently show zero by the final day of the month? The capital dissipates through invisible system leakage. Every month, $830 vanishes into dining out and unmonitored subscription renewals. The final $100 acts as basic friction loss, a negligible buffer that inevitably evaporates on untracked spending before the month concludes. Measuring $3,400 of known spending against $3,500 of income creates the dangerous illusion of a surplus, masking a compromised architecture. We fix this with Rule 1, priority routing. This shifts the entire model from a reactive spend-then-save flow to a proactive force-save-then-spend flow. The exact moment the paycheck clears, $500 is mathematically intercepted and routed to an external account before a single bill is paid. By physically removing that $500 from the ecosystem, the unmonitored outflow budget is mathematically capped at $430. This forces an immediate reduction in dining and subscriptions without the need for strict micro-budgeting. Rule 2 is debt phase-out logic. That $350 monthly payment toward the personal loan will clear the balance entirely in 11 months. When that balance hits zero, a strict logic gate must trigger. The freed $350 is split evenly, $175 routed to build a starter emergency buffer of up to $2,000, and $175 allocated to lifestyle expansion. This permanently prevents the cycle of reborrowing. Rule 3 dictates asset allocation. That intercepted $500 is routed directly into a Roth IRA to secure tax-free compound growth. Inside the IRA, the capital requires a precise diversification matrix. $300 buys into a total U.S. stock market fund, $100 secures international equity, and $100 stabilizes in bonds. Rule 4 addresses risk mitigation. Despite his youth, anyone with dependents requires the immediate integration of term life insurance. The math dictates a 10 to 15 times income multiplier. For a $58,000 earner, a $750,000 term policy is the required mathematically sound target. Finally, Rule 5 is the raise protocol. This is an automated logic gate applied exclusively to future revenue increases. A standard 3.5% raise yields roughly $169 a month. That capital must be split perfectly in half, routing $85 to investments and $85 to lifestyle. Wealth compounds invisibly while living standards incrementally rise. This visual proves the math. The left side is the initial zero-sum state. The right is the optimized cash flow. The control model leaves high structural risk, zero liquidity, and credit reliance during emergencies. The optimized model secures tax-free growth, debt elimination, and risk mitigation. The data reveals one critical insight. Between these two radically different financial realities, the $3,500 net monthly input never changed by a single cent. Wealth generation for early career professionals relies strictly on automated system design, not an endless supply of behavioral willpower. Note that this data model provides general financial education, not personalized financial advice. Always consult a licensed professional before executing structural changes to your portfolio. Evaluate your own cash flow architecture. Review the math and identify which specific system leakage in this model most closely mirrors your own.